All right, welcome back. Joining us virtually to answer our financial questions, we have Nick Sapienza. Nick, good afternoon.
Hey, Taylor, good to be back.
It's good to have you back. So, okay, yesterday we saw the market hit an all-time high. So, is it necessarily a good idea to invest right after something like that happens?
That's a great question. I get this one when we haven't hit an all-time high. I get this one routinely, and I'm not going to bury the lead here. So yes, this is normal, okay? And I know people would look at me and say, of course, I'm always going to say it's a good time to invest. But let's really back into some of the evidence and the data behind this. We average more than 12 new highs per year, and following an all-time high, stocks were up roughly 70% of the time. So the bottom line is we usually see all-time highs that lead to more all-time highs. And why? Well, one oversimplification of the concept of momentum is that people like buying things that are doing well. The problem with this question is that people are equating an all-time high with a peak. It's what we would refer to as gambler's fallacy. They think surely we've hit black 6 times in a row. We're not going to hit black again, so I'm going to go red, and then the market goes black, etc. So you get the idea. And I don't want to diminish a 12,000-point rally that we've seen since March. That's a lot in a little bit of time. But peaks are meaning that the market's going to crash next. And look, a few of those highs will be peaks, but most will lead to more highs down the road. So the answer has always been to simply invest and not try to time the market. But this doesn't satisfy the emotional side of the equation for most. And for others, it seems to be lazy at first glance because it's lack of complexity, which is actually why it works well in the first place. So my answer is always to dollar cost average. And what that means is that you're not going to have an all or none mentality. We're going to minimize regret, which is the basis of the question usually. How do I avoid regretting my decision to go all in? The answer is don't go all in. It's to create a plan that allows you to systematically leg into the market at a predetermined date, at a predetermined amount, over time so that you don't have to be right about the timing. And I'll leave you with this. My colleague, Nick Maggiulli, writes a blog called Of Dollars and Data. I recommend Googling it. In his research, he found that the average dollar cost averager outperformed the quote-unquote all-time high avoider 82% of the time in all 30-year periods going back to 1928. So to summarize, that means that you'd be much better off investing despite an all-time high, but you don't have to do it all at once.
I think that answers that question pretty nicely, Nick. Thank you so much for joining us virtually to discuss this topic. If people have any other finance questions, how can they find you?
You can email me at nick.s@ritholtzwealth.com.
Wonderful. And if you guys missed anything Nick just mentioned, don't worry. All of this is going to be on our website, klaf.com. Nick, thank you so much for joining us today.
Thanks, Taylor.